Chapter 2a. Budgeting. As a general rule, people who know how they spend their money have better control over their finances over those who do not budget. I'm preparing an in-depth video about what budgeting is and to show you how I conduct mine. I will add the link in the description once it's ready. Back to the module. At a minimum, we all need to meet some essential outgoings. Let's call them our fixed expenses. You have rent, phone bills, utilities. Ideally, we'd like to have some left over once we've got all of these covered successfully in order to cover large one-off expenses like Christmas presents, and for those of you who have debt, be able to pay the minimum necessary. Assigning a client to draw up a detailed breakdown of their expenditure, or what we call a budgeting exercise or a fact find, helps you determine whether the client is living beyond their means or not. In case there's a surplus, that's where financial planning can happen. Budgeting can be also of paramount importance to people who live off investment income. And this is because, pay attention to this, dipping into the investment capital will reduce its ability to produce the required level of income. This means that if you withdraw more money than you need to and you take some from the capital you've invested initially, you will be making some income as a percentage of the capital which you have lowered now, which means it's the capital's ability to generate income will decrease. From the fact find, you, the advisor, should discover the monthly needs from the client's answers about their income and outgoings. Examining both the income and expenditure allows for an intelligent budgeting assessment. What this means is you can explore with your client the possibility of redirecting spending from some areas of lesser importance to others who must have priority. For example, reducing the entertainment and going out and spending budget and redirecting them to life assurance or debt repayments could be very beneficial to the customer. Focus point. The two key pieces of information to determine a balanced budget for your client should focus on both income and spending rather than simply any surplus they might have. As future financial advisors, we will deal with many people who carry debts that ought to be managed. This can be achieved by listing all sources of income, savings, investments, rental income, any salary or pensions they may have, and then look at the expenditures, which can be split into three categories. We'll see why this is important in a second. The first category is essential spending. These are expenses that you must meet for your life to remain constant. Think of your council tax bills, utilities, rent, and insurances. Then you have the everyday spending, food, travel, and then you have occasional or non-essential. These are your clothing, entertainments, and holidays. This hierarchy comes into play when the client is struggling to make ends meet. What we could suggest in this case is cutting spending from the third category and reducing some from the second and making sure the first remains constant. One more thing that we could do is check the APR or the interest rate that is charged on their credit cards or loans to show them how much their cost of borrowing really is and possibly encourage them to shop around for better deals, new utility suppliers, negotiate phone contracts, perhaps shop at Lidl instead of Waitrose moving forward. Right, not all debts are created equal, and so priority should be given to mortgages, utilities and council tax over credit cards, overdrafts and personal loans. If the debt problem persists, then it's best to encourage the client to contact the entities to which they owe money to set up a new repayment plan. Once all essential debts are taken care of and there's a surplus income, then we can move to unsecured and lesser important ones through a debt management plan, also called a DMP. This can be set by the client themselves or a debt management company that can negotiate on the client's behalf with the creditors, the people they owe money to. Some private companies charge a fee for this service. That's why I always recommend Step Change, which is a debt charity based in my city, Leeds, which does a terrific job helping people. There's a method called debt consolidation, which is a debt restructuring mechanism. In effect, you negotiate a new loan to repay one or many loans together with a new set of rules. For example, a new interest rate or a different kind of monthly payment. Focus point. Be careful here. This isn't a perfect solution, since most consolidations carry an initial fee. Also, if the client is stuck in a spiral of borrowing to pay existing debt, then this might not be a great idea after all. And finally, if any loan is secured on their property, they might end up losing it if they fail to repay the loan. Failing all else, bankruptcy remains an option, as well as an IVA, which stands for Individual Voluntary Agreement. So what is a bankruptcy or an IVA? Bankruptcy is when all of your possessions are taken into account in order to pay creditors. However, an IVA is much more flexible as an arrangement. It means that you come into a conversation with your creditors and you agree a repayment plan with some costs associated with it. It comes with its own set of rules and costs, but it remains better than a bankruptcy bankruptcy in a lot of cases. These are legal proceedings that carry costs and affect the client's ability to borrow for many years to come, so never be too quick to recommend them. Remember, no matter how bad the situation looks to the client, there's always a way to work out a plan and rid them of the debt shackles. And I think it's essential that we remind them and help them find comfort in this fact. The financial side of things can be dealt with via a debt management plan, loan consolidations, liquidating any assets they may have like a buy-to-let property, any cash or investments. But on the psychological/behavioral side, we can recommend debt counseling with charities like Citizens Advice. On the next chapter, let's look at mortgages and loans.